International Financial Management. In second class, ICAI Ashish Gupta, Deputy Director, Board of Studies, welcomes you all. Student, in today's session, we shall continue our discussion on one or two questions on the international financial management that is related to the capital budgeting decisions. Okay, then thereafter we shall move to another sections. What are the various other aspects of the international working capital management related issues? Assignments 2 has been already been uploaded. I hope you must have downloaded the same. Now in today's class we shall finish up this topic on international financial management. As usual, if you have a query, you can contact us at the telephone number that I will share with you in the end of my session. Okay, student. Now let us start our session. Okay, student, we have done up to the question number. In the last session, we have done up to the 5. Okay, today we shall remaining the balance question of this assignment. Okay, that is relating to the adjusted present value. Good morning, Satish. Good morning, Shruti. Okay, student, now let us read the question, then I solve it for you. Now, the life of the equipment is 10 years. The depreciation of equipment charged on the straight line basis. It is very important. Economic life of the instrument is 10 years. EBITDA, EBITDA that is earning before interest, depreciation, tax, and amortization. Okay, is to be collected from the toll road is projected USD 33 lakh per annum for the period of 20 years. Now here, student, please note, it is very important to note, here it is a 10-year life of the equipment, and here the tenure of the project is 20 years. So here we have to note a very important point. To encourage investment, Nepalese government is offering a 15-year term loan of USD 1 lakh at an interest rate of 6% per annum. The interest is to be paid annually. The loan will be repaid at the end of 15 years in 1 year, one tranche. Okay, that is one in one go. The required rate of return for the project under all equity financing. That is more important because all equity financing means the funding of the project has been completely done from the equity only. Okay, the 12%. Post-tax cost of debt is 5% per annum. Corporate tax is 30%, and all cash flows will be in the USD. Ignore inflation. You are advised to management on the viability of the project by using adjusted present value. Now, what exactly is this adjusted present value method? Okay, student. Now, I just show you what exactly basically adjusted present value method is. One second, student. Student, please note, generally in traditional NPV, generally it is assumed that first assumption is that project has the same risk, has the same business risk, I will say, as or we can say not risk, we can say businesses as the parent, as parent, that is parent company has. Okay. Another point is that the debt equity ratio, debt equity ratio for the project shall remain the same. Okay, these are two major assumptions. Okay, when we do any project. Okay, in this case, what happens? One second. So, however, it may be possible that this assumption may not be met out. Somewhere there can be any change in there. So, what happens? Generally, they may be, in reality, they may be differing. Okay, they may be, but in reality, okay. So, in this case, APV approach, that is basically based on Modi-Gilani Miller approach, is followed. Okay, then as we generally use in valuation of levered firm. Okay, so accordingly, I'm not going into the nitty-gritties too much. Okay, I'm not going to. The basically formula is base case NPV plus present value of tax benefits of present value of tax benefits of present value tax benefit of interest, subsidy, or other benefit. Okay, student. Now, here a very important point. When we say PV, so the present value factor that will be used here shall be at pre-tax cost of debt. It is very important. Okay, please note this point. The present value factor that we will use, that will be as a pre-tax cost of debt. So this is a base case NPV. Okay, we shall compute base case NPV. Okay, on that basis we shall compute then we add up the tax benefits, etc. Okay. In the question, we can see that we have been also provided with the various tax rate. We have been provided with the various present value factors. Okay. So I hope it is clear to you now. Now I move to solving the question. Once the question will be we solve it, the concept will be totally clear to us. This question is from our earlier examination. First computation will be okay. First we shall compute base case NPV. Okay. I'm just drawing a table. Period. We write it like USD lakhs. Okay, PV factor. Here we shall see. Now let us, I am taking you back to the question. Have it data. Now, factors have been given to us in the question. Accordingly, we shall use annuity factor. Okay, tax rate 1 to 20. Now we shall take the tax benefit. Okay, 30% of the same. Not tax benefit, that is a tax. Okay, depreciation. Now, depreciation benefit is basically for the 10 years. That is not for the 20 years. That's why we are showing it separately. It is very important. Now, generally, whenever we carry out the computations, you have observed students that normally depreciation is for the same year, same period for which the project is there. But here the project is life is 20 year and depreciation life is 10 years. So we are considering the tax benefit separately. It is very important point here in this question. Okay, student. Now let us see, because we have taken here these factors are for 20 years. Here this factor is at for this. Now let us see. I am just showing you these factors. This factor as well as this factor, though I am showing you on the table. See here, this factor is 12 here for here 5.65 and present value annuity factor for 20 years is the same. So we have taken here for the 20 years EBITDA post tax. Here we have taken it for the 10 years. Okay. So overall we calculate NPV 35.091. Now we come to the next one. We can say PV of PV of on interest Okay. So first PV of we computed like that. Our tax saving, see our loan amount is, just I show you the loan amount. See here, student, they will take a loan of 1 lakh 50 lakh, 150 lakh at the 6%. Okay. So 150 lakh into 6%. Okay. It comes 9 lakh. Okay. So this amount is of interest. Okay. Now this amount is of interest. So accordingly, we shall see what is our tax benefit on the interest payment. Again, this period is for 1 to 15 years. So here we are seeing for different periods, we have been given different uh, treatment. We are for different periods, we are giving different treatments. 1 second, student. Okay, so we take, oh, I think it has been erased. No problem, tax benefit into PV IAF at 8% for the 15 years. Okay. Now here our tax rate is 30%. Okay. Our interest payment is 9 lakh. Okay. USD dollar. Sorry, it is not rupees. It is USD. Okay. Into present value annuity factor is 8.559. Okay. The value comes USD in lakhs, 23.109 lakh. Okay. So accordingly, we calculate now APV. Our base NPV is minus US dollar 35.091 lakh plus US dollar, we compute 23.109 lakh. Okay, our answer is minus US dollar 11.982 lakh. Okay, so now decision is, since APB is our negative, just a second, student. I think today's there's a problem in this iPad. Now we have to, you are required to advise the management on the viability by using the APB. Since our APB is a negative, it is advisable not to accept the project. Okay, student. So with this, I hope you must have the concept of APB must be clear to you. Okay. Now, student, there is one question in your study material as well. Now we are coming to the last question of the first assignment. Okay. So that, just quickly we read it. Prashant is asking, sir, why we calculate in such manner? Prashant, see, here there are two things. One is, as I told you, generally whenever we simple use the traditional NPV, we their assumption is that it's a project financing pattern is the same. Okay, because project financing pattern from project financing pattern, it comes to know it is linked to the debt equity ratio. But however, here they have a different debt structure. The project life is of 20 years for which they are taking a loan of for the 15 years. So of course their financing pattern is totally different. So in that case, we assume that first of all we use the all equity financing pattern, then we consider the tax effect. Okay, it is very so we takes the benefits whatever the PV of the tax shield that we have to consider. So this is called adjusted present value. Actually, this is if you remember that when we are using the approach in our intermediate, there it is discussed because they separate the financing impact from the business impact. Business risk is separated from the financial risk. Satish is asking, sir, how factor is arrived by computing tax benefit? See, Satish, basically 8% because ultimately we can use only one time tax benefit only. That's why here using we pre-tax cost of debt. And it has been by the formula generally we use. So I cannot go into the very depth of the formula, but this is the approach is used everywhere. Okay. I hope it is clear now. Okay. Thank you. Now I'm coming to the next question. XYZ, a company based in India, manufacture very high quality modern furniture and sells to a small number of retailer outlet in Nepal. It is facing uh, it is facing tough competition. Recent studies on marketability of product have clearly indicated that customer is now more interested in variety of choice rather than exclusively exceptional quality. Since the quality wood in India is very high, the company is reviewing the proposal for the import of the wood in the bulk from Nepal supplier. The estimate of the net Indian rupees, this is Nepali currency, okay, and cash flows in nominal terms for this proposal is this. It means they are inflation adjusted. So here, Nepali currency is this much. This is our investment. These are inflow. These are inflows. These are inflows. These are in Indian inflows. The following information is relevant. XYZ evaluates all investment by using the discount rate of 9%. All Nepalese customers are invoiced in NC. Cash flows are converted into rupees at a forward rate and discounted at Indian rate. Of course, very simple. We shall convert. So we can came to know which approach we are using. We are using here home currency approach. Okay, we are using home currency approach. Inflation rate in Nepal and India are expected to be 9%. Okay, it is expected to be 9% and 8% respectively. Now, student, please see here. Since the inflation rate has been given here, so please remember when the term we have been given nominal term. So it means it is already inflation adjusted. Okay. Thank you, Devraj. Thank you. Okay, the current exchange rate is rupee 1 is equal to Nepali currency 1.6. It means 1 rupee is equal to 1. Assuming that you are finance manager of this and calculate the net present value and modified internal. Now, my purpose here to take up the question to make you understand this concept of modified internal rate of return. Okay, friend. Now let us solve the question. See, in the question, when we are given the question like that, so as I told you, first of all, in international capital budgeting, we have to use either purchasing power parity theory or interest rate parity theory to calculate the forward rates. Okay, so let us first calculate the forward rates. The first step our will be to calculate the forward rates. Okay, now end of year 1, 2, and 3. Now here we make computation. Nepali currency 1.6. Now here we shall use the purchasing power parity. Sir, if Prashant is asking, sir, if cash flows are given in real term, then you have to get it converted. Okay, then you have to get it converted into the inflated terms. Then you have to multiply respective. Now, very good question. I really appreciate Prashant what the Prashant has asking. I'm just showing you, student. Sorry, just tolerate with me today. My iPad is quite a bit slow. Now, Prashant, if these are in the case of is it has been provided in the real terms. So we would have inflated these cash flows by using 9%. Of course, it will not, we will use 1.08, 1.08 raised to power 2, 1.08 raised to power 3. That we would have done like that if it has been given in real terms. Very good question, Prashant. Okay, so I'm just erasing the same so that it may be not be any confusion for you. Okay. Okay, now we shall convert second working note in Indian rupees. Okay, now we shall compute the net present value. One second. I think okay, now let us compute the NPV. Okay, cash flows in India. Okay, total. Now, present value factor we shall take at 9% because we have converted into home currency. Okay, now here we have computed this. Now it says we have to compute modified internal rate of return. Now let us see what exactly he means to say. Okay, assuming that finance calculate the NPV we have done with modified internal rate of return. Okay, when we calculate one modified internal rate of return, just I show you how it is calculated. Now, student, the solution is in your study material. Okay, you can refer the same table from there. I'm just explaining you the logic that it will be clear. Now, students, see, we do here in this case reverse type of calculation. Now, year one cash inflow reinvested for a period of 2 years. Okay, so accordingly, our first year cash flow is 4.479. Accordingly, it is invested for the 2 year. Okay, so value comes this much, 5.32. Similarly, year two cash flow reinvested for a period of 1 year only. Accordingly, our cash flow for the second year is 6.53 lakh into 1.09. So the amount comes 7.10. Okay, now year three, accordingly, our cash flow for the third year is 7.09. It will be multiplied 1.1 plus 0. So it will remain the same. So I think this makes you very clear. Now, when we compute the modified, it means at what rate we are reinvesting the same. Now we add up all this. We add up all this amount. The total comes 19.53. Okay, then we compute MIRR. This is called terminal cash flow. Since duration of project is 3 year, we write it here 3 year minus 1. Okay, that is 7.72%. Now, student, is not here. We have come out with the that is modified internal rate of return means, of course we are considering that our cost of project we are return from expecting from the project is 9%. Since actual return is basically 7.72, so we can say that it, instead of get expecting a return of 9%, we can say, now question comes, we should expect only 7.72. Now student, most important point here, now this is a Q proved. Okay, normally this cannot be calculated, can be calculated from your ordinary calculator that is available in examination. In examination, if you come across any such situation, please leave the question here. You not to worry about what will be the answer. ICAI will take care of the same. Okay, because these calculations generally face the problem. Okay, so you not to worry about the same. We will take care of the same. Okay, students. So with this, we come to the end of this our first assignment. Now I am taking you to the our second assignment. Before I take up the second assignment, one or two things I want to discuss with you. Then with you regarding the how we what are the various other aspects of the international financial management. So there are one or two concepts like ADR, GDRs. Okay, ADR means and GDR means any say what we mean by ADR. ADR means when an when a non-American company issuing the receipts to the American residents. This is called ADR. Okay, and if they are issued in any other country other than their home country, any company, so their company issuing the ADRs receipts to the any other country's people, that is called GDR. Okay, now let us. I am just showing it to you. Okay, generally ADR, GDRs. Generally, they are kind of a receipts. Okay, backed by shares. Okay, maybe more than one share. Okay, generally these is what they do. Generally these are issued by the companies. Okay, shares are issued by the companies. The shares are purchased by the custodian bank on the behalf of the investors. Okay, in a home country where the company belongs to, and then the custodian bank issues the receipt against the same. So when we will do the solve the question, you will understand what is the ADR and GDR. My request to you, you can go through the same from your study material. Okay, one of the very important concept I want to discuss with you, that is called netting. Okay, netting means there are two type of netting: bilateral netting and multilateral netting. In bilateral netting, there are only two things. Say A has to give, B has to give rupees 100, okay, and A has to give B 50 rupees. Okay, so we can net it off. Okay, under the net of arrangement, A will get only 50 from B. Okay, now in case of Multilateral netting, there may be more than one party, A, B, C, D. Okay, so there may be some like transaction like that. Transaction may be like that, this way, this way, this way. There may can be n number of ways. Okay, so this is called when we settle off this. Generally, this is used in case of multinational companies. Now, in your study material, I want to in your study material just refer the page number and just on a page number 11.29. Okay, there is a inter-subsidiary payment matrix has been given to you. Now I will show you by way of diagrammatic presentation of the same how the overall so many transactions are come to many only few transactions. Okay, students. Now let us see. Okay. Now from the pin affiliate table, first we discuss Germany has to pay France 40. Okay, student. Now UK has to pay 60 to the France. Okay. Now next is Italy has to pay 100 to France. Okay. So we write like that. Now next we come Germany. France has to pay Germany 60. Okay. Next is UK has to pay Germany 40. Okay. Now Italy has to pay Germany 80. Now we come to next. France has to pay UK 80. Okay. Germany has to pay UK 60. Okay, student. Guram is asking, sir, in a study material, there is a diagram of cash management. Please discuss how it works. Okay, let me check. I think it is a very You are right, but I think there is some diagram, but I think this diagram is will take lot of time. Cash management diagram, I think it is on the page. Cash flow of overall MNCs. Uh, yes, actually, Guru Ram Beta, this is basically a very broad diagram. It includes many aspects. Okay, so I think it will take a very long time because I have to just, if possible, then in this session, if possible, then I will try to cover it up, or otherwise somewhere in any other session, I will try to cover up the same. Uh, Shruti is asking, sir, what is the basic difference between ADR GDR? Shruti, basically ADR GDR, there is no any major difference. Only is that when it is holding the receipts for the Indian company share, so they will be called GDRs. Okay. So generally these are ADRs generally treated in the stock exchange of the America. Please note it. ADR is generally treated is traded in the stock exchange of America, whereas GDR traded in the worldwide, except from the company, from the country from which they are issued. Okay, like it may be possible that in India, IDR may be there. Okay, in IDR means IDR, Indian Depository Receipt means any non-Indian company has issued the receipt against the shares of the against the shares of any foreign country. So these will be called IDR from the Indian perspective. Okay, and okay, student. Now let me just concentrate on this diagram because if any line is missed out, then it will be a problem. Just 1 second. Okay. Let me come to the point. Just where I missed it out. Mm, Italy has to pay Germany 80. UK has paid to France 80. It is over. Germany has to pay 60, and Italy has to pay now. Italy has to pay UK 70. Okay, Italy has to pay UK. Now I am coming to next 70. Okay, now I am coming to next entry. France has to pay Italy 100. Okay, Germany has to pay Italy 30. Okay, and UK has to pay next step. In the next step, we can see there can be some inter-adjustment can be done. How it can be done? Here there is a in a France and Italy there is a exchange of 100. So we can cancel it out both. Okay. Now there in a first step, France has to pay Germany 60 and Germany has to pay 40. So this can also be set off at somewhere around 20. Okay, similarly here this can be set off around 20. Okay, here same way it can be settled around 10. Okay, now here 60 and 40 and 60, this can be settled around 20, and here it is can be settled around 50. So first we carry out the bilateral net. Okay, first we carry out the bilateral netting. So I am drawing next diagram. Okay. So first step in which we have done bilateral netting. So here it comes this, that comes 20. Okay, student. Now you see here, somewhere we can see that there one another possibility of clarity also, because here Italy is paying 50 to Germany, and then Germany is paying to UK 20. Okay, so we can say that possibility is that instead of paying 50 to Germany, then it will pay. Ultimately, what does Italy do? Italy add up 20 amount, okay, and minus 20 from here, and minus 20 from here. So ultimately, we can say one step is also eliminated. Okay. So next possibility, we can say, okay, so this will be the way out. Or alternatively, there will be another way out also. I do one thing. I just write down the again this. Okay, I just this is the second diagram. So I'm looking for other possibility. Okay, now here UK instead of paying Germany 20, it does not do UK, rather France pay Germany 20. Once more of a Shruti is asking, yes, you can to say it is because bilateral means two, between the two settlements. Of course, it is a one more bilateral. It can be possible. So here we see that there is one another. Okay, so instead of France paying Germany, then Germany paying to UK, it directly pays a UK 20. So this another possibility of diagram will be last will be Okay, student. Now I think it is clear to you. Net payment ultimately has been shown. So payment ultimately net payment on the account of France is 40. Okay, net receipt, the total of the same for UK is 50. That is plus, that is minus 40. Okay, Germany is in the receipt of plus 50, and Italy ultimately is paying minus 60. So you can see overall what was a very big calculation, very big exchange has come to into see. If I take you to a first diagram, there was this much of cluster was there, and ultimately this has been reduced to this. So this is the power of the, or we can say beauty of the netting. Okay, student, I hope this must be clear to you. Now I am start taking up the assignment number. One second. Just hold on for a second. Let us, before going for a break, we shall solve one or two questions. Just read the question carefully. Jyoti, I think it is clear to you now. If it is still not clear to you, please do let me know. It is a part of bilateral, extra bilateral, not we are more making one more. One second, your point is bilateral. To some extent, it is a bilateral. We cannot say it a bilateral because it is involving minus not, because there we are involving three parties. It will not be called bilateral. One not more. Yes, you are right. Your point is right. It is will not be bilateral because we are involving more than ending its operation and planning to install manufacturing plant in US. It requires USD dollar project. The estimated flotation cost of the GDR is 2%. The expected market price of the at the time of GDR is 360. The face value is 10. 100. Now, at the time of this is the face value of the share and by shares. Okay, receipt is backed by the share. It can be more than one, or generally it is more than one. Issue shall be priced at 10% discount. Okay, to attract generally foreign investors, we make we offer at securities at discount. Now, expected exchange rate is US INR USD 12. That means $1 is equal to rupees 72. Dividend is expected to be paid at the rate of 20% with the growth rate of 12%. You as a financial okay student, what is your suggestion if the company receives an offer of from the US willing to provide an equivalent loan at the interest of 12%? First of all, we compute the GDR, what will be our cost. Okay, so overall there is a procedure, very simple procedure. There is not much complications are involved. Now, so first of all, we compute. Okay, since this is of net of flotation cost. Okay, we shall compute. You are saying, but sir, in the discussion in context of this netting off, so generally these netting of MNC is the 2%. Okay, so our gross size comes. Okay, now issue price per GDR in rupees. Okay, 10%. Okay, it will be backed by two shares. Okay, accordingly, the price comes, please compute the price, it comes 648. Okay, now up to it is clear to you. Otherwise, I more explain to you. It comes like this beta, or we can say like this. Okay, so 648. It is in price of GDR in Indian rupees. Now, since it will be issued outside, US dollar. Okay, so we do like this: 648 divided by, okay, true. Now, next thing, dividend. Okay, so per it will be get, it is backed by two shares, so it will be in Indian rupees. It will be 40. Okay. The next is here per GDR price is 648. Okay, 2% is flotation cost. Okay, so accordingly it comes. Okay, student. So I hope it is clear to you now till now. Now we shall start computing. What have we have been asked to compute? Okay, cost of GDR. Now here we shall compute the cost of GDR in Indian scenario. Okay, it is just like D1. Okay, it is like P. Okay, this is plus growth, that is basically G. Okay, student, clear? So ultimately the cost comes to the company is 1800 18.30. Now companies seek your suggestion. Okay, if see in the question it says like that, what is your suggestion if company with 12 within an interest of 12%. Now see company needs this much of million USD dollar. So any another company that is ready to provide them 8.82 million with rate of 12%. So what will be there? What should they do? Now here three, because if we take up the company takes up the Raghu Limited takes up the route of uh, say GDR, then of course their costing coming 18.30. So if what will be the route if the company, because here 12% is less than our 18.3%. So there, uh, Prashant is asking, sir, is what is written after dividend per GDR? Okay, beta. Is per what is written after dividend per? Okay, let me check. Maybe some typography notes. Dividend per GF GS value of 100. So the formula is like that. Okay, so basically I'm just writing here the formula. To you, please do ask me again. Prashant, please do ask me again. Okay. If it accepts, second answer, Raghu Limited ignoring 400 fluctuation. Second answer, uh, okay, you are asking about beta. I think Raghu Limited is ignoring inflation. Okay, 1 second. Raghu Limited. Gururam beta, I think inflation will does not play into the come into the picture because generally when we calculate the cost of capital, it is from into NPV etc. So foreign net fluctuation is like see this I just tell you your point is valid point. Now once the GDR issued, so they will be issued in foreign currency. But however, they will be because see they are using the plant they were installing a plant at USA. So whatever be the remittance will come into the US dollar, it will be utilized in the US itself. So there will be no question of foreign exchange fluctuation. Their concern is only to calculate the cost. Okay, because ultimately they are issuing their own shares. Please you see the logic behind GDS. Behind the GDS, ultimately what is happening if we see overall calculation, the overall calculations hover around the shares that are backed by that are backed with the GDS backed. GDR is backed by some shares, and on that these shares we are calculating the cost of equity. So there is no cost will be utilized at plant in at US. So there will be no such issue. Okay. So with this, I hope the doubt being must be clear to you. Now, student, we are going for a small break. Okay, after the break, we shall continue our discussion on the same topic. Okay, student. So let's have a small break. Now, continuing our discussion, I think, let me check, is it sharing or? So we were, before going for a break. Okay, student, now let us solve the second question. This question is from our earlier examination of ICAI. Now, it's a very good example how the excess cash is uh, handled by the MNCs, because ultimately when they have excess cash, then they have to park the money. So all this are discussed in this question. Very, very good question. If any MNC may have some excess cash or deficit, they can be adjusted with each other. Or if they have a surplus cash, generally this cash are remain for the short period, say 3 months, 6 months, etc. So they can invest into some commercial paper or money market instruments. Now let us solve the for a period of the funds. So they have to pay the interest to the and flag fund. OSD, okay, and obtain the best rate without any fluctuation risk. The following interest rate of the 8% per annum. New York rate of interest is 8% per annum. Then Frankfurt is this 3%. The London market rate market rate in London for the US dollar is the euro is as follows. So now these are the exchange rate. Okay, these are exchange rate. This question has a very unique feature because it will test the students' ability. Because here of the foreign exchange risk management also, because here we have been given give bid and ask rates. Both rates we have been given. Okay, so we shall these rates have been given. These are spot. These are 1 month. They are premium. Okay, points are there. This is spot rate. Okay, so these have been given. So at which rate the will be the investment will be made, and what will be the net gain to the nearest pound to the bank on the investment. Now here it has said to the nearest pound. Okay, of course we have a dollar with us, but we shall compute the gain in the pound. Okay, so student, let us solve this question and you will understand how this surplus cash is invested. Okay, I just make it on the next page. First, we carry out the investment if at London. Okay, convert. Now here you have to apply your foreign exchange exposure techniques. Okay, I am hopeful. You must have been. Why we have taken 5390? I'm not going into it because it will take more time. The rate is we shall use this rate. Okay, so the amount comes pound 324886. Okay, we have converted USD into pounds. Okay, at the rate of 5%, we compute interest at the rate of 5% for the 3 months. Okay, or we can say like that. Now, when we talk about the pound, so what rate we shall take? Student, please note here. This we have to consider it here. So we shall consider here this rate because we shall take conservative look here. We shall make like that. Whatever we are losing, okay, what we are losing, that will be on higher side. Okay, so accordingly, we shall use 1.5350 plus 0.080 basis point. This is due to our conservative outlook. We say it is a kind of an opportunity that we have. Sir, what it means cost of bank to bank? Prashant is asking, sir, what does it mean cost to bank? See, when the depositor have invested their money in the bank, of course, they are expecting some interest. So ultimately, bank is paying 4% to them. Okay. So this pound return is 1662. Okay, we are through with the first part. Now we come to the next part. The investment is made at New York. Okay. Simply here we shall see we will gain of 8% minus 4%. Okay, that will be on, okay, for 3 by 12, 3 months. Okay, student, no problem. Equivalent amount. Okay, so what rate shall we apply here? This rate we shall apply here. That is 1.5390 plus 0.00 85, 1.5475. Okay. Here again we are taking conservative approach outlook, that is we will get lesser amount. So this is the second case. Now we are coming to third case. Now here the cross rate will be come into the picture. Okay, how it will come into the picture, because USD will be converted into, say, our London New York rate are there. It means it is pound versus US dollar. Okay, here it is London pound versus euro is there. Okay, now we need this rate. Okay, so we shall use here the concept of cross rate. Okay, student. Now euro equivalent of US dollar 5 lakh. Okay, add interest amount after 3 months in euro. Okay, 3 month forward selling rate, 3 month forward selling rate of euro in pound will be 1 divided by 18150. Okay, so it comes pound. Okay, student. Now sell Just a second. It will be now here amount invested and interest thereon. We have computed here. This amount we have computed here. Okay, student. So we see how much profit we can compute it, how much in benefit we can see here. We evaluate each option. Okay. First investment is made at London. Okay, we can do something like that. Summary. Gain is found 3231. If investment is made at Frankfurt, okay, the gain comes 2047. Okay, so out of this gains, the maximum gain we are getting at 300 is. So accordingly, we write the answer. Okay, student. I hope this question is clear to you. With this, we are moving to the next question. Okay, this question is also from your earlier examination. A very interesting question. Just I am reading out the question. ICL Limited, an Indian MNC, is executing a plant in Sri Lanka, raised rupees 400 million. Okay, if how half of the amount will be required for the 6 month time now will not be okay. ICA is looking to opportunity to invest this amount on 1st April 2004 period. Actually, I think there is a misprint out. Will not be required आएगा here. Please add this. Will not be required. Okay, half of this amount will not be required. This will be required. Sorry, half of this amount will be required after 6 months time. So it means we have a time of the 6 month. ICM is looking to an opportunity to invest this amount on 1st April for a period of 6 months. It is considering two underlying proposals. First, investment that can be made in Japan. Another investment we can made in Germany, US. Okay, nature of investment, index fund. and here it is treasury bill. Now here we shall get a dividend of 25 billion. Okay, yen. Okay, here the income from lending, this is 11.9275. Okay, in discount on initial investment is 2%. Okay, now this is a rate have been given to us. Similarly, treasury bill 5%. We shall get simply the 5% income. There is no other gains are there. This is the our rate. You as an investment manager is required to best course of action to be followed. So here we have to analyze. We have to make the investment. Okay, we have to make investment in two options. Either we can make the investment in Japan, or either we can make the investment in uh, of course in US. So where if we make the investment in Japan, so it will be converted into Japanese yen. So first let us analyze the case of Japan. Okay, here the figures are in billion. Now amount available is 200 billion. Okay, our exchange rate. Now what will be the exchange rate will be applied? Let us see. Here our exchange rate on the spot is this. Okay, it means our one INR is equal to, okay, so our exchange rate is 1.58. So available amount is this. Now what will be our income? Okay, stock lending scheme, or we can say stock lending income. Okay, investment value at end after discount of 2% because the value will be discounted. Now here please note we have invested 316. So our value will be 316 into 0.98 because it will be discounted. The value comes 309.68. So overall we can say whatever we the left with the value amount available in the at the end 346 we add up all this 346.6076. Okay, now convert in INR. Okay, on so this here the rate will be 1.57. Okay, so we divided by this amount, so resultant figure comes. Okay, so our gain will be, our initial amount was 200. Okay, end amount is 220.796. So our gain becomes minus. Okay, student. Now this was our gain at Japan. Okay. Now let us discuss if investment is made in US. Okay, so particulars, exchange rate and currency in USD. Okay, beta. Now let us start calculating each item. Amount available, it is 200 billion. Applicable rate is, so accordingly in Indian, in USD, it becomes 2.8 billion. Okay, now interest for 6 months at the rate of interest per 5% per annum. It becomes 7%. 7. Here, if anyone has a doubt, so please do let me know. Okay, so both gains are student here. If however is, is more certain, then we should opt for the same. Point 1 January, we can say 1 January 20 into 2, that is another year. 20, we can say the 201, the X sold his investment. The other relevant details are this. So it is, we can say it is the beginning period. Okay, it is ending period. Simply. Okay, so Indian stock index in stock market, this, it is unknown to us. Okay, standard and S&P, standard S&P index is basically UK, USA based. Okay, this is this much, and this is closing value. Now exchange rate is having given to us. This is expected forward rate. You are required to calculate the return to the US. So subject to exchange rate risk. The value of index of stock value as of India is one at which X would be indifferent will be in the standard poor market, standard poor index and stock market. So it means at what index value they will be indexed. So we can say this is the third part. Okay, now let us start solving the question. Okay, so here it is very simple. We take the ending value or we take the opening value divided by opening value. This will be our return for the US. Now we compute the return for Mr. X. Now let us start solving the same. Okay, now initial investment. Applicable exchange rate. So this is our ending price. Okay. Okay, student, market. So ending price between two market index we have purchased this much of index. So ultimately our ending value should be to the amount ultimately we will get of index that will okay then okay. I think Jyoti, please check at your end. So this will be the at index because we have considered it x. You can presume it as I, you can presume it I. We are computing this value as equal to sorry, this is the okay, no problem, student. I think I have solved it before this. Now, Kumar Jyoti, please asking, see, better in this question, what happens? You have been given the choice. Okay, first of all, we have computed in the first part an investor to the US investor return. So US investor you let me see what happened. The US investor, okay, US investor. Just I take back to the question. Now you see the thing when here, so you will be sell there, purchase there and sold in the US currency. So there will be no exchange rates. So accordingly, simple ending price minus initial person who is Mr. X, Indian investor. So he this much of Indian rupees, whatever be his gain, it will be two. It says the value of index. Okay, that X 1.58 crore. Now purchase number of index. Now we assume it is clear to you. In case still you have any doubt, please do let me know. Now I am coming to the next question number 5. Suppose you are a treasurer of XYZ PLC in UK. XYZ have two subsidiaries. One is based in Amsterdam, another is Switzerland. The surplus of the surplus funds in the hand is as follows, which it does not need for the next and Dutch subsidiary here. So they have two are there. Amsterdam is the euro is there. Okay. Then it says what rate? We can say this is kind of the deposit market. Deposit in the money market are this. So there are slabs are there. Okay, these are different rates are there. Okay, these are different. You have been approached by your banker wherein you will invest there. Okay, this subsidiary investor at their own country. From and this Okay. Next, we are making investment at, since GBP is there, there is not an issue. So total comes beta. This much of amount is of investment in Great Britain pound is available. Now we invest this amount. 1 second. Just 1 second, student. I think amount accrued on individual basis. So now we have what amount we place here. Whatever be the amount that has been accrued in our first step. Okay. This much of amount accrued on individual basis. Okay. So we need how much of interest amount there? So this much of interest we amount. Okay. So required interest rate per annum. Okay. So we can say thus minimum rate to be offered for swapping. Okay, student. Now I hope this question is clear to you. It was a very simple question. Okay. So in this question, if you have any doubt, please do ask me. Otherwise, I am moving to the next question. Okay, this question says like that. AMK Limited is an Indian-based company, has a subsidiary in US and UK. Forecast of the surplus funds for the next 30 days from these two subsidiaries, US this much of amount and UK this. Following exchange rate or information is obtained. So there is no bid, no ask, only one rate. Amount of borrowing and deposit rates are as follows. So here we see borrowing will always be at higher rate. Okay, it is in Indian rupees. This is in dollar. It is on a higher side. Lending is on the lower side, or we can say deposit rate. Pound is there 3.9, 3.7. The interest rate are to be based on 360 days in a year. First, calculate the cash balance at the end of 30 days period in rupees each amount. Company under each of the following scenario, ignoring transaction cost and this. Each company invest on finance. Okay, invest means deposit and finance means borrowing. Okay, its own cash balance is deficit, that is surplus, in a local currency independently, or they what they do cash balance are pooled immediately in India and the net balance are invested or borrowed for the period of 30 days. Means it is called pooling. Whatever there is deficit or surplus, and if they want to borrow, so they will borrow the balance amount or they will invest the balance amount. So let us see the solution. Solution is very small, is not that much big that it appears. Okay, first, so I can do like this. Okay, India, US, and UK. Capital. Here it is a deficit. So we write here negative. Okay, interest. It will pay interest. Now it will pay interest. How much it will pay interest? 2667, because here our deposit rate is 6.4%. Okay, we can compute here also. 5 lakh into 6.4%. Okay, so this amount comes here. Okay. Similarly, when we have this amount, we have 250 with us. Okay, so interest amount that it will get 15.63. How much he will get? 12,500. Okay, student. If you have any doubt, so please do ask me. Here, the interest amount will be found. Okay, student. So here we come. 30 days. Okay. Now here what we do? 5, or we can say 125. Okay, rates are given to us. Student, just carry out the calculation here. Rates are 1 second. Hmm, just 1 second. Okay, so we divided by this, divided by. Okay, student. Now here we are writing the rate another. The amount will be 401. This will be. Okay, student. So with this, we see here this is our surplus, this is our negative. So overall, the value at the end comes. Four 75 323. Okay, student. Now, second option we consider if we do immediate pooling. Okay, so immediate cash pooling means, okay. So this much of the immediate pooling, okay, amount invested at, so gain is, okay students, now we can see if we doing acting independently, independently, so balance at the end of 30 days is negative. Okay, we are getting this much amount, and even if we doing the pooling, so it is the beginning and we are getting this interest also. Okay, we are getting interest. So ultimate net gain we can say, okay, so this will be our net gain. Okay, student. So thus immediate pooling is advised. Okay, student. I think it is clear to you now. Now with this student, we come to the end of the topic of international financial management. Student, there is one important announcement here. See, BOS is coming out, BOS for the success webinars. Okay, they are starting from the tomorrow. Okay, in this series, our there is a schedule. You go through the schedule. Okay, in this BOS session, I will summarize what will be the chapters, what are the syllabus. So you can please, my request to you, please watch this session because you consider this session as our concluding session. Okay, we are assuming that student, because of course there are one topic has been, two topics that have been left out, that will be completed in the forthcoming classes. That one class is tomorrow. Okay, but my request to you, please go through this session because this will be ultimately considered as a concluding section from our side. So my request to you, please do watch. We consider, of course, classes are left only merger acquisition and startup finance is there. We shall cover in the two or three classes quickly. Okay, so my request to you, please go through this session, BS for the success in first exam. Now, as a custom practice, if you have any query, please do send us as a mobile BS or you contact us as 0120 3045 956. Okay, student. So my request to you again, please do refer, also go through the questions as well as illustration from the study material in addition to the questions that we have covered in our assignment. Okay, students, thanks a lot. Thanks a lot for patient listening. We shall continue. We shall continue our discussion in the next class for the another topic. Okay, students, thank you. Have a nice day. Thank you.